Hi everyone, this is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a chartered market technician and he's editor and publisher of the Daily Gold. He's been covering the gold market, I think, since 2010, Jordan?
Yeah, professionally since 2010, but I mean, I've been following gold publicly I've been covering it since 2005.
Great. Jordan Roy-Byrne, thank you for joining me.
Hey, thanks for having me, Jason.
Now, Jordan, I want to ask you, a big picture question first. I've asked this to my guest last week, John Embry, who's been managing money in the gold market for 40 years. If I were to tell you during the 2008 financial crisis, looking back from now, that global central banks would create 18 trillion out of money and credit out of thin air, the general stock market would be up 250%, the bond market would still be in a bull market, and a lot of cities' real estate prices would be like the 2008 financial crisis happened, and yet here we are at $1,307 gold and a little over $17 an ounce silver. What would have been your reaction if I would have told you, those other asset prices would have been that much higher and the gold price would have been at these levels?
Well, I definitely would have been very surprised. Although I would say, breaking down the last 8 or 9 years, I think the reaction or the how it played out, I think you can kind of divide it into two parts. And I think the first part played out how probably most people expected. Money would go into hard assets and we would get a recovery because it was obviously a very severe recession. And, after a recession, a severe recession, you're going to get some kind of recovery, and you pump a bunch of money in, you are going to get a recovery in asset values and in the economy. And so I think the first part of that, especially through 2010, 2011, that made sense that makes sense to me that hard assets would really lead the rebound. You would get a recovery in equities and you would get a recovery in the economy, but it probably wouldn't be that strong at first. And I think the real surprise is just not necessarily the bear market in gold. I mean, obviously that was a big surprise, but looking back, I mean, gold had a really long run without a real bear market. Jim Rogers would always mention that, and so it makes a lot of sense. I mean, I have a chart in my book where I compare gold to other bubbles, and if you see where gold was in 2011, it was at a point where it was either going to go parabolic, continue to go parabolic, and probably peak out at 3,000 or 4,000, go really parabolic at the end, or it would have to come back down and have a pretty big correction that would last for at least a couple years. And of course, the latter happened. So but from that point forward, I think the real surprise has been the fact that the U.S. economy really hasn't. I mean, I guess statistically it strengthened a little bit in 12, 13, and 14, but I think the real surprise has been that the economy, that this expansion has just continued to go on with such weakness. It hasn't fallen into recession yet, but we've continued to see slow growth. I mean, forever we've been in terminal slow growth. That continued, and so that's been a surprise. But even more so has been the fact that stocks have just continued to rise spectacularly. I think that's been the biggest surprise. So not that there was a recovery and that it would last for a couple of years and stocks would do well, but just how long it's lasted. I mean, that's really been the surprise to me. And the fact that the economy hasn't gone into a recession. But I guess if you think about it, if you have a severe, massive recession, then it could be a long time before you get the next recession. Because growth has been too weak to build up any real malinvestments. At least any real obvious malinvestments. We haven't had anything like speculation in tech stocks in the 90s and real estate in the 2000s. We haven't seen anything like that this cycle. I mean, we have seen money go into the U.S. equities, and the valuations there are obviously off the charts. But that by itself is not, has not caused a recession. Yeah, I mean, even if there's a bear market at some point, that could cause a recession. But those would be my comments on that. So quite simply, the first part of it, not that surprising. I would have believed that, but it's really what's happened since 2010, 2011, specifically with the economy just kind of going on with this weak expansion and stock prices just continuing to go higher and higher despite a really weak economy.
Yeah, I think things are stagnating. That would fit into my stagflation thesis where, the asset prices are soaring, but the real economy, I think there's a lot of evidence that the real economy in the US and the global economy for that matter are not doing well. I want to ask you now about the gold chart. I sent you a chart from the Bullion Baron from last month, and it looks like, on the monthly chart, the XAU against the dollar, that the gold chart is starting to put in a really nice inverse head and shoulders pattern. Obviously, we need to close strongly above 1300 quite a bit more, and then maybe go above 1350, and then it could be, very big rally. Is that what you see also in the analysis?
Yeah, I mean, there's definitely a bullish bottoming pattern or basing pattern, whatever you want to call it, that's been taking place, or that really, if you're looking at the chart, you can go back to the middle of 2013 after gold really had its crash. And I mean, it's not a perfect inverse head and shoulders bottom. I mean, technically it would be called a complex head and shoulders bottom, but this pattern, I mean, patterns have to be, the market has to break over a certain level to really trigger that pattern. Or making it realized, I guess you could say. And I mean, the 1350 to 1375 level is very key if you're looking at the daily or the weekly or even the monthly chart. So we really need to get above those levels. And if we would get above those levels, then there's a potential upside target of roughly 1650 or even 1700. So again, the potential target of 1700 is there, but the odds of hitting that target, we can't really talk about it until gold is able to go above 1375 or even 1400. The real key actually is on the quarterly chart. If you look at a quarterly bar or candle chart, 1330 is the key level, and gold has bumped up against 1330, and it hasn't closed above that on a quarterly basis since before it crashed. So September is the end of the quarter, so that's something I'm going to be watching over the weeks ahead, and I would encourage everybody else to watch that. Let's see if gold can close September above 1330, because that would be at the end of the quarter, which is obviously more significant than a monthly close and then a weekly and daily close. But just looking at that chart, the 1330 resistance is so obvious. And so for me, if gold can close well above 1330 in September, that would tell me that it's probably going to have that breakout and break above 1375 and 1400, in the months ahead. Now, if gold can reach 1375, but it doesn't make that monthly close or that quarterly close above 1330, that would probably tell me that, maybe this needs to consolidate for, 3, 4, 5, 6 more months after that. So there's definitely a bullish setup. The first thing was we had to get above 1300. We've done that. Now the second thing is let's see if we can get a close above that quarterly resistance at 1330. And as you know, Jason, I mean, the end of the quarter is important because that's when, you see funds books and there's a lot of quarterly reporting. And so do fund managers want to hold their gold positions into the next quarter or not? And, we'll find out.
It seems that there's a lot of current events that are creating tailwinds now for gold. You have the events going on in North Korea with the North Koreans, I guess, still potentially, I guess they launched a missile that went over Japan, a test rocket. And then you have the debt ceiling looming, and it doesn't look like, the Democrats in Congress, well, even the Republicans don't like Trump. They don't want to go along with Trump. So that's probably going to be an issue, too, if the debt ceiling isn't clean and it's not, agreed upon immediately. So all these things, because we saw with the last time there was a huge debt ceiling problem in 2011, that was one of the catalysts that moved gold even higher, even faster. So it seems that there's, a lot of catalysts potentially building for gold now in the near future.
Yeah, I mean, I focus on negative real interest rates and falling real interest rates because based on my study of the market, that's the number one driver. But a lot of these other things, I think, have definitely been driving the market. One thing that's interesting, I think, is the dollar. And because gold actually, up until the last couple of weeks, gold was actually not performing that well. And same thing with silver. while the dollar was falling and making new lows. And so that's a little bit of a concern for me, is the fact that the dollar is getting so oversold. I mean, maybe it can fall to 90 or 88 on the dollar index, but it's had a really steep fall, and you really want to see gold performing well in against stocks, against foreign currencies. You don't want it to just be a dollar-based move, because if the dollar is going down but gold's only going up because the dollar's going down, then that's not really a gold bull market. That's just a dollar bear market. And so that's the one thing that concerns me. I'm watching gold against the stock market to see if that ratio's had a mini breakout. There is some resistance coming up, but if gold can continue to outperform the stock market, that would be a really good sign, because there is a long-term negative correlation there, which has been present since 2011. And I mean, we also had that in the late 90s and the early 2000s. That sprung that bull market. There was also evidence of that a couple times in the 70s. So watch how gold performs with respect to the stock market. I think if the stock market has a legitimate correction, not this 3 or 4%. I mean, there's people on TV talking about a correction. This thing is it's gone down 2 or 3%. I mean, that's not a correction. If a correction of 7, 10, 12%, I think that would be enough to get gold to 1,400, and maybe it would even go higher based on that. Whereas if we do see, if the government gets its act under control, maybe Trump calms down and tries to actually pass something, that would be, the dollar would probably rebound, and that would be negative for gold. And maybe the stock market would stabilize based on that. So that is definitely a factor that you can't really predict. It's very difficult to predict, but it definitely will impact gold going forward. But I mean, the real big impact is always negative real rates. And the Fed, I mean, I was wrong. I've been cautious on the market. I thought the Fed was probably going to hike rates because inflation, the dollar's really low. And now they have the cover to hike rates because the rest of the world is doing better, and they don't need to worry about the dollar getting too strong. And inflation, I mean, it has kind of stabilized in recent months, although it looks like it may be starting to pick up again. So I thought the Fed, obviously there's still time. Maybe they will hike in December, but who knows? But I think gold is basically telling us as of right now that the Fed is not going to hike. And so if that's the case and inflation perks up a little bit, I mean, that's negative, real rates are falling. That's very strongly bullish for gold. So that's also something that I'm keeping my eyes on. We'll have to see if this horrible storm in the Southwest, if that's going to impact energy prices at all. You could probably speak on that better than I. But, that's another factor that could unfortunately raise inflation in the months ahead.
Well, the conventional thinking in the financial community, Jordan, is that raising interest rates is bad for gold. But if you go back and look at the 1970s gold bull market, it actually didn't affect the rising gold price. So, Volcker had to take interest rates enormously high. I think 19% or 20% was the absolute high. And then he had to manipulate the gold price. He talked about it in his memoirs to knock it back down. They had to change the rules on the Hunt brothers. I don't think we're going to see interest rates, moved by any country that high, considering how much intervention there is by central banks into their bond markets. But I want to transition now and ask you about the rebalancing of the junior miners ETF, GDXJ. In your opinion, how badly did that rebalancing, did it actually hurt the technicals and the shares of a lot of the junior miners, either in the index or just not even in the index, but just quality juniors, maybe by association?
I mean, I guess I have kind of a contrary view on that. I really don't think it impacted the sector that negatively. I mean, there were some companies that were negatively impacted, but then there were others that weren't as impacted. So that was surprising to me when looking at the charts of especially some producers in there. There were a couple that were getting really negatively impacted that people were talking about, and then there were some that nothing was really happening. They weren't even going down. So I guess I have a contrarian view on that. I think people were kind of using that as an excuse as to why the market was going down. But at the time earlier this year, the miners had a really strong rebound. I mean, GDXJ had a really strong rebound. It went from 27 up to, I think, 43 in a very short amount of time. And so it was kind of overbought. And then we saw the miners were underperforming gold from that point into the spring. So I think that was a bigger factor for the weakness in the juniors and the actual rebalancing. And I mean, I forget when the rebalancing ended, but GDXJ has quietly in recent months been able to slowly recover. And of course, it had a really good day yesterday, the 28th, Monday, and it was up a little bit today. But yeah, I have a contrarian view on that. I don't think it was as negative as a factor as many other people thought. And I think obviously GDXJ was a victim of its own success, and that too much money was coming in, and so the fund had to take really big positions in these companies, and it didn't want to have more than a 19.9% position in a lot of these companies, so it had to reduce its position. And with GDXJ, I mean, it's almost turning into a mid-cap ETF. And with a lot of these juniors, I mean, for me, by the time the junior gets put into the GDXJ, that for me tells you it's too late to invest in. I mean, yeah, you can invest in and still make money, but what I'm trying to do is really find the smaller juniors that are just starting out that in the future can be successful and make it into the GDXJ. So obviously that's higher risk, but for me, I just think once they get into the GDXJ, they're a little bit too big, and then their upside potential is kind of limited over time. So those are my thoughts on GDXJ. I'm not a huge fan of it. I mean, I'm a fan of building your own GDXJ with smaller juniors. Obviously, that's very tough for most people to do. And if you want to invest most of your money into the gold sector and the junior miners, then I would say you should build your own GDXJ. But if not, maybe GDXJ is fine if you buy it at reasonable prices. But overall, I'm not a huge fan of it.
Those are interesting viewpoints. A lot of my listeners, in the comment section, a lot of them, I think sentiment-wise, what they're doing is, they've given up, especially U.S. retail and U.S. And Canadian retail investors. A lot of them have been liquidating their gold positions, liquidating their silver positions, liquidating their mining shares. And, now that Bitcoin and Ethereum and some of these other altcoins are going up like crazy, they're in, a huge speculative bull market. And with these initial coin offerings, one of my buddies on a speculation who's a financial professional, he turned $600 on ICO into $12,000 in only 2 weeks. What they've said though about juniors, Jordan, and I know you have a track record of picking out winning juniors, but maybe it's because a lot of these junior miners are marketed extremely aggressively, and normally the ones that are paying the most money for marketing are normally the worst companies. Like it's a YouTube channel that's pumping it, or it's a newsletter writer that's not properly disclosing it, maybe in the fine print that he was paid 10 grand or 20 grand to promote the company, or given 50,000 shares and warrants and things like that. So how would you say? Can you still pick out winning stocks in this price environment where gold hasn't gone up that much? How do you do it then? What are some of your secrets to success?
Well, first of all, I totally agree with your comments. There's a lot of conflicts of interest in the industry, and a lot of people don't disclose that properly, as you said. Here and now, I think I'm looking for juniors and more on the exploration side. I mean, I kind of look at different subsets of juniors. I mean, you have your optionality plays, which are companies that have a big deposit, which is not economic, and so it could become economic at higher metals prices. So those, the optionality plays are basically leverage plays on gold and silver. And producers are a little similar because for a producer, I mean, it's very difficult for them to grow their production. I mean, it's a process that can take a number of years, and so most of the time, they're most affected by the movements in metals prices also. And with with producers, you really want to look to buy those when they're very cheap and sell them when they're high. But I focus most of my recent time and attention on trying to find the exploration juniors that have potential to have 5 or 10 times gains. And the reason is, as you know, I mean, the larger companies come after this bear market. I mean, they just don't have, their pipelines are really bare. They haven't spent money on new projects, and so they have to acquire these deposits. And so regardless of metal prices, the larger companies, the seniors, they have to acquire the best deposits that are basically all owned by juniors. And we've already seen that happen. And also this year we've seen, I think I heard, the seniors have invested something like, not just the seniors, but probably the intermediates as well. They've invested something like a total of $300 million just into financings into these junior companies. And I mean, you even have seniors that are investing money into really tiny juniors. And so they're just getting a stake in these companies. And, you know, maybe if these companies find something and they advance it and it looks like it's going to be successful, the senior will acquire these companies. And, you know, if not, they'll at some point in the future sell their position. But so the seniors are, you know, regardless of metals prices, they need to find these new deposits. And so I'm looking at the exploration juniors that really have potential to find stuff that the majors want to buy. And so I think and look, if these companies can find economic deposits at 1,200 gold, I mean, you can still make a lot of money on these things even if the gold price isn't moving much. And so that's what I like about exploration juniors, and that's really what I'm looking for. And I mean, it's some of the things you want to look at. You want to look at companies that have basically really large district scale land packages. So land packages that could host multiple mines, not just one mine, for example. You want to look at things that have potential to be, you know, plus 3 million ounce deposits. You want things that have potential to be high margin projects. In other words, you want things that can make money at 1,200 gold and, you know, don't need 1,400 or 1,500 gold, because if they need that, then it's really an optionality play. Also, you want to look at juniors where, you know, maybe a senior miner has invested in it. I mean, you can find some of these companies where the senior maybe invested in it last year and the stock is trading much lower than that point. And so that obviously some of these juniors, if a senior invests in it, that gives them some credibility that maybe they have a chance to actually find an economic deposit. And yeah, yes, I would, you know, all these things need to be promoted because there's really no product differentiation. You know, they're all looking for the same thing or selling the same thing, gold. So these things do need to be marketed, but it's a great point that you made because the valuations in this sector, I mean, you can find something that looks really good and, you know, maybe its market cap is only 30 or 40 million, and then there's something that's okay, but, you know, it's marketed so aggressively and it's worth 200 million. And if you talk to people in the industry, they'll say, yeah, you know, that's not really worth anything. So, I mean, these are the types of reasons why people, they need to educate themselves. They need to, you know, listen to podcasts like yours. They need to be, you know, very skeptical of what they hear. And they need to, you know, if you're listening to someone and you're getting advice from them, you know, find out, do you own the stock? What price did you buy it at? You know, what price do you think it's a sell? I mean, there's all these factors that really, you know, go into, you know, a recommendation to subscribers. I would just be skeptical of everything you hear and, you know, fact check it if you can. Because I mean, it can be a very slippery slope. I mean, as you said, I mean, there's a lot of conflicts of interest.
Yeah, it's extremely frustrating. You know, I was pretty, I knew a lot about investing in finance, but I got involved in gold and silver around 2008 and 9, and so I didn't know exactly how all the mining stock promotion and stuff works. And you know, you learn through trial and error and the reputation of people, whether you know, whether they're doing things and saying things and things are being executed the way they say. I mean, despite this you know, not a bull market in gold and silver, the prices haven't gone really anywhere. Eric Sprott has picked out winners. He's found, you know, Kirkland Lake Gold has had a huge discovery at one of their producing mines. There was a merger through that in Australia, so that's a higher grade discovery, and now that mine has a lot longer reserves, and that's that stock has gone up a lot. There's been a potentially big discovery for Novo Resources that Eric's was an early investor in Australia, potentially district scale there. Chris Marchese over at the Morgan Report, people criticize David Morgan because his free interviews, but his pay interviews, I'm sure, Jordan, you're aware of these companies. I want to highlight the winners because my listeners are saying, none of these companies are doing well. We have Leah Gold, which I think Frank Giustra packaged. They're a mid-tier Mexican gold producer. That stock has done very well. It's still undervalued, and they have a growth plan. And then Klondex Mines is a producing gold producer too. So there are winners there, but not everyone in the gold industry who's picking out stocks is going to find them. So you have to have a track record for finding winners. There are winners to be found even in a bear market. It's just not going to be as plentiful as during a bull market or what's happening right now in Bitcoin and the cryptocurrencies, where basically a rising tide is lifting all the boats.
Yes, absolutely.
And the other point you brought up, Jordan, and I think that's an excellent one, is replacing reserves. So, I was going to ask you about the Q2 2017 earnings for primary gold and silver miners. One thing I noticed is that, a lot of the larger companies, they cut their costs. Maybe they eked out a decent earning or maybe a little bit of free cash flow, depending upon their maintenance CapEx and what those CapEx costs were. But one thing I really noticed is they're struggling to replace a lot of their reserves that they've already mined, and they're struggling to come up with new ways to increase production if they want to grow their company with exploration. So maybe they're spending a little bit of money right now on like brownfields exploration around the mine, hoping to replace some of the reserves or resource around the mine with maybe a little bit higher cost resource, but they're not able to adequately replace their reserves at the current metals prices. I really don't think, you highlighted how trying to find those large gold district deposits with 1,200 gold, I really don't think there's that many of them anymore. Pretium Resources has built a mine at the current gold price. I mean, there's a handful of gold mines at the current gold price that are either being constructed or built, but that's few and far between. For primary silver, Jordan, I think it's only Mag Silver, and they're not a normal junior. They have, Fresnillo as a partner. So I think, we're to the point where there's just not many projects out there that are really economic at the current prices. So I think the miners are, I've talked with miners off the record. I think they're hoping to just tread water, and then they're hoping that the gold price will go to 1,400 or 1,500 so that they can do some of these acquisitions, like you said. And for gold and silver, I think primary gold and silver miners need 25 to 30, or there's going to be problems maintaining the production levels.
Yeah, well, because of what you said, that's why, I'm looking at even earlier stage explorers, ones that don't necessarily have a resource yet. And obviously there's a lot of risk that comes with that, but that's why you have to, I'm really careful to look for these things that have value and real potential. And obviously they're risky, but if you have these factors in your favor where you look at something and it looks like it has a land package that can, host a district scale land package. If they have that, there's some soil samples or something else that shows an indication of, there could potentially be a deposit there. And if something like that is trading at a compelling value and the company has cash, those are the things that I'm looking for, because, maybe those things, they're not, most of them are not going to work out. But if metals prices rise, the stocks will go up. And if these companies can just, even if they have some good drill results or they start to find something, just based on that, tiny companies can make really significant moves. So those are, you're even, if you talk to some of the best people in the junior industry, that they're even going further down the food chain and looking for, these types of things, because when the cycle turned towards the end of 2015, the obvious economic projects that were already there and that were relatively advanced, all those things got taken over in 2016. And so that's forced a lot of investors to go even further down the food chain.
I've interviewed Nolan Watson and Sandstorm Gold a lot. I'm friends with a lot of the people in that company, and they look at financing a lot of these juniors. So I think it's important to get to interview people like Nolan Watson about the juniors, because he looks at most of the projects. In his opinion, he thinks that a lot of these juniors, when they release preliminary economic assessment or pre-feasibility study, he thinks that they tend to a lot of these companies tend to underestimate their costs, sometimes 40% or more. Have you gotten burned in a situation like that where maybe the stock pops after one of these economic releases, like, oh, the mine's economic now, they're going to be able to build this economic gold mine for a couple $100 million, and then when they update, one of these economic, and if you don't sell, then you get burned when they release their next economic projections and the costs are double. What's your opinion on this with juniors, accurately releasing these economic projections for costs?
Well, I mean, PEAs are obviously preliminary, and they can be, not as serious or truthful as you'd like them to be. But that's what I've learned is, like, if a company does a PEA and then they go right to doing a pre-feasibility or feasibility, then I think the PEA has some merit. But if they put out a PEA and then they just stop after that and they're not going to do a feasibility study, that tells you that, in most cases, the PEA is really, really preliminary, and not, you can't really put anything on it, because if it was significant, the company actually felt they had a deposit that could be economic, they would spend the money necessary to take it the feasibility route.
That's interesting. Do you also take, if you get a pop, when a pre-feasibility or preliminary economic assessment is released, do you also take money off the table then if you have a big gain, just in case, something like that happens, what you said?
I mean, it's so hard to answer because it really depends on a number of factors. It just depends on so many factors. So many other factors. I mean, what's the trend in the gold market? What's the company's value? I mean, if the stock pops but it still looks undervalued to me, then I would be willing to continue to hold that. But if the stock had already had a really big run and then it popped, then that good news, as the markets kind of lead the news. And so in that scenario where the stock anticipated the news and then maybe it surged after the news and it looked really extended on a valuation basis, then I would probably take some profits. So I mean, there's just with all these things, there's just so many different factors to consider. It's just difficult. I mean, if a company puts out a PEA and there's really not that much of a reaction, then it's the market is telling you it doesn't really matter, it's not significant, and then the company obviously has to go back to the drawing board. Maybe they have to increase the resource or try and find higher grade somehow. So there's many. I wish I could give one or two direct, sharp answers, but there's just so many factors that go into every situation, and it makes them, no two situations are alike.
So I think that's a good example then of why, the average retail investor who is not familiar with the sector really shouldn't be, buying juniors based off like YouTube promotion, or, they have to be careful who they trust with information about the sector. So, you have to look for track records of either the person who's building the company with the mines. Do they have a track record of building juniors from discovery up to a mine, or are they a successful stock newsletter writer who's seen, situations like this in the past with companies where, there could be potentially, drastic understatement, potentially maybe fraud, where they're understating their costs, or, it's a legit time to hold on to the stock. So that would be where people would want to probably either follow someone with a track record building the mine, or pay for an expertise with a stock newsletter writer like you, rather than, I think there's so many retail investors out there, Jordan, who just listen to free YouTube videos, and they think that they know what they're doing, and then I hear all these horror stories blaming people blaming other people, when these are adults out here. You need to, if you don't understand the sector well, you need to make sure that you're getting the right information from the right people.
Yeah, I completely agree with that. And I think I mentioned on the last interview or the last couple interviews we've done, one tactic I like to employ is in your portfolio. I mean, if you, let's say the average position is a 5% position, if you use a mental stop loss of 20%, that limits your portfolio to 1% downside. I mean, look, this is if you, first of all, before you buy something, you should ask yourself, could this go down 20%? I mean, obviously it takes some expertise to really have an idea, but so I mean I actually don't do a lot of I don't do a lot of buying. I mean, I have done buying and I've bought a few things in the last week or two. But other than that, I mean, most of the buying that I did was in December and January when the market was oversold and rebounding. And so, I mean, most of the time I'm not buying because I ask myself the question, realistically, is this something that could go down 20%? And if it can, then look, you have to wait and you have to wait for that to consolidate, wait for it to correct. You could come back to it later and buy something else. But number one, if you ask yourself that question, then that's going to prevent you from buying into things that have already gone up a substantial amount and may be susceptible to correcting 20, 30, even 40%. And then when you actually buy it, if you give yourself a 20% mental stop loss, you know that if you buy something and it's down 10%, 13%, 15%, then you should be saying to yourself, this is not working out. Just got to take my loss here and move on. I mean, just the people who you buy something and then it keeps going down and down, and there's no reason to have a 70% loss or a 50% loss. There's no reason to have more than a 20% loss in these things. I mean, be careful about what you're buying. Be careful when you buy it, and then tell yourself when when you're going to sell it. You have to know when you're going to sell it, because if something goes wrong and you don't know when you're going to sell it beforehand, then you're just going to get emotional. You're probably going to hold on to it. You're going to continue to lose money. So you need to have some discipline with the way you buy and sell these stocks, and how much money you're putting into these stocks. And as you said, look for people like me. I mean, I am plugging myself, but everything I talk about in the newsletter, I'm buying myself. I'm completely transparent about everything I own, everything I'm doing. There's a few other people who do that like me. But I mean, you have to seek out people like that, and you have to be very careful and skeptical. And look, over time, you're gonna increase your education, and you're gonna learn more. And investing, it's not just a 1 or 2 year journey. It's a lifelong journey. And just be very careful, be skeptical, try and learn as much as you can, and always have some kind of mental stop loss so you can prevent yourself from buying into something and then just having a 70 or 80% loss. I mean, that's just you can't let a loss get out of control. You have to cut something at a certain level and go back to the drawing board.
The other mistake that a lot of retail investors tend to make, Jordan, is we've talked about this in past interviews, is they tend to also buy they read something in your newsletter. They don't listen to advice about buying partial positions. They either read, this has happened to me when I worked in the newsletter industry as well. We would, in our different newsletters, we would put out a recommendation. We would say not to buy in all capital letters, an entire paragraph of all capitals. Do not buy all of your position at once. Buy partial positions. Do not put all of your money into any one stock pick in our newsletter. We have a model portfolio for a reason, and then people just ignore it. So I think that's a very common mistake, as people hear about this junior. It's happening now, I think, with a lot of these altcoins and initial coin offerings, and so far none of them have collapsed yet or gone to zero. So no one's lost their pants yet, or a lot of their nest egg in these cryptocurrencies. But with these junior miners, people will read a couple story stocks, and they won't listen to. I think in the past you've talked about a 3-pronged approach to when buying in thirds of a position. People won't listen. They'll just buy everything at once. And then, Jordan's wrong. He doesn't know what he's talking about. Well, you didn't listen to the model portfolio recommendation. You didn't listen to not buying your entire position at once. So, these are things that if you're a retail investor, you really need to read the fine print, reread the newsletter multiple times. I want to ask you now about sentiment. Based on what you've seen for maybe your subscribers, other people you're talking to, either in the gold community or readers of your newsletter, do you think sentiment for gold, silver, and mining shares is extremely bearish and maybe some of the worst sentiment you've ever seen?
Before I get to that, just a final comment on promotion. I do want to say not all promotion is bad, because in my newsletter, I mean, there are a couple things that I own that have been heavily promoted, and I've told people this is heavily promoted, but the promotion is really legitimate. Like, there's legitimate potential here. So that's another reason why you need to subscribe. Again, I'm plugging myself here, but why you need to subscribe to people like me, because and you could attest to this, Jason. The longer you follow an industry, the more contacts you have. I make calls, I talk to people. What do you know about this company? What do you know about this project? So, and so I can figure, through my contacts.
I want to hear about management too. I want to hear if the management has ever screwed anyone too.
Yeah, exactly. And so just those, those are the kind of things that you can pick up. Or I mean, you or I can pick up, because we've talked to people in the industry, and we can get a real sense of, okay, which properties are really, which promotions are really just junk, which promotions actually, have some credibility to them. And so I didn't want to, I don't want to leave people thinking everything promoted is bad. It's just that you need to follow an expert who can tell you, look, there actually is legitimate potential here, but these two or three over here, no, that's just garbage. That's all promotion. So that I just wanted to make that distinction. But as far as sentiment, I don't know if I would say sentiment's the worst ever. I mean, it depends on what indicators you look at. As far as short term, like the daily sentiment index, that's one very popular indicator. And gold and silver, they had a big jump yesterday, but I think gold is around 60 and silver is around 55. So in the very short term, and even if you look at like a moving average of those sentiment indicators, which is better for the medium term, those things tell us that gold and silver can continue to run because sentiment is not that bullish. However, if you look at the COT, the commitment of traders, I will be very interested to see the next couple reports, because these reports obviously showed that, I mean, in the early July bottom in the market, I mean, speculative positions in gold and silver were very, very low. But over the last 6 or 7 weeks or so, now we're seeing a big increase in those positions. And look, for gold and silver to go up and be in a bull market and just keep going up and up, you're going to have more people speculating. So it's not always bad when speculative positions are going up. It's just that when they've been going up for a while, or they reach a certain level, then there's potential for some profit taking. So looking at the speculative positions, I think that silver could go to 1850, gold could go to 1375. So those are kind of the targets I'm looking at. When we get to that point, I'm a little concerned that at that point the speculative positions will be too high and will tell us that maybe we need to see the metals correct a little bit or consolidate for a few months. But in the bigger picture, I mean, if you go back to the late 2015 low and just the valuations in precious metals, I mean, you compare them to you compare them to other assets like stocks. You look at the amount of money as far as positions that are investments in precious metals versus other things. And so from a big picture, long-term perspective, I mean, there's barely any money in precious metals. So if the right conditions come about and we see real interest rates plunging, maybe after the next, recession, that'll happen. I think that could be when we see metals really start to take off. There's a lot of room for, massive moves higher in gold and silver with respect to long-term sentiment. I don't see it necessarily happening like in the next 12 or 18 months. I think these massive moves could be 2, 3, maybe 4 years away. But yeah, I mean, as far as the short term, I think sentiment is favorable for gold and silver in that they can continue to run here. Medium term, I'm a little more cautious, but in the big long-term picture, Jason, there's just, I mean, you look at these ratios, you look at how much money is in stocks compared to gold. I mean, even there was a chart I was looking at the other day. Unfortunately, it escapes me now, but it showed that I think the average position in precious metals or gold, I think it was 4 or 5% or maybe 3 or 4%, at the 2011, 2012 peak, and now it's only down to 1% of the average portfolio is in gold. I mean, these are just that's just asinine compared to just compared to how undervalued gold and silver are, I mean, relative to stocks and the long-term potential. So again, if if the right conditions come about for gold and silver to rise, they're going to rise spectacularly. You will see gold go above 2,000. You will see silver go back to 50, and it maybe eventually go above 50. But I'm not trying to hype these up for the next year or two. I personally think
King World News.
Yeah, I personally think that those price levels are probably closer to 3 or 4 years away.
$50 tomorrow. King World News.
Yeah, I mean, just when you hear those predictions and just there's one great thing that Bob Moriarty talks about in his book, and it's signal versus noise. And a signal is something that is based on fact. I mean, if you're looking at sentiment indicators or charts or data, I mean, those are signals. Noise is stuff that can't be measured by data. And so when people are talking about things that they just seem really extreme, and silver going to 50 tomorrow, something's going to happen, and gold's going to go to 2,000 in a week. There's no facts that back that up. There's no signal there. That's just all noise. So when you're listening to interviews and reading things, try and differentiate between signal or noise. If it sounds a little fishy to you, it's probably noise and it's not signal. So follow the people that are using facts and giving signals, not noise.
I think there's a divergence in the sentiment. So I think, you brought up how managed money has rotated out of gold over the years. I think now a lot of people who are thinking more long-term, so we have, Ray Dalio, Jeff Gundlach, Stanley Druckenmiller, they're starting to rotate their profits from profitable bond trades, profitable stock trades, profitable real estate investments they've had over the years since the 2008 financial crisis. They're starting to move into gold because they're looking for what's cheap. And, on a lot of valuation metrics, there's really very few assets that are cheap. Gold hasn't risen. So they're rotating more money into gold. Now, everyone is not doing that. But I think the sentiment where it's the worst, though, is among U.S. retail investors, Canadian retail investors, because, with the mint sales, the bullion sales, if you talk to bullion dealers in the United States, their sales are down quite a lot. Since for most of 2017, really since Trump won the election, sales are down a lot in both those countries. But if you go and look at demand for physical metal in China and India, it's still very strong. So I think, there's kind of a divergence there with sentiment where in the past, the people maybe who believed in gold and silver, that it was manipulated, that was going to go up a lot, that the global economy had all these economic landmines, that, these things were going to set off quickly. And the reality is, I think the central banks, Jordan, have just gone in and papered everything over. We know from the balance sheets that they've released, it's over 18 trillion. Now, most of the money has obviously not gone into precious metals like a lot of people were thinking. It's gone into the other assets first. But, there's going to be another global financial crisis because I don't think any of the problems with the last financial crisis were really solved. Everything was just papered over. So, the asset prices have reflected that things were papered over. We have a lot of the government data that's kind of pretending that the economy's doing well in certain cases, but I don't think the economy's really creating jobs. So I would still, if I had more cash, I would be buying things that are cheap. I know a lot of retail audience that are going to listen to this podcast. They're going to call me, gold bug and silver bug, because they're putting so much of their money into Bitcoin. Because I've heard people, I don't know, I'm sure you've heard something like this, Jordan. Maybe you've had subscriber cancellations, but I'm hearing people telling me, why should I listen to you? Because I've made more money in Bitcoin and Ethereum, in these other altcoins, and in speculating in these initial coin offerings. I made more money, in 6 months than I have in years of gold and silver.
Well, I mean, it's all a product of timing, and look, Rick Rule always says, don't confuse brains with a bull market. I mean, you and I can attest to the fact that, we appear to be much smarter and much better investors, when prices are rising. But, if you humble yourself, you should realize that that's just you're making money in Bitcoin. It's a speculative blow off. It's had a great bull market. I don't know anything about Bitcoin. Maybe it continues to go higher. But if you look at the scope of that, it's going to collapse at some point. I'm not saying it's going to go to zero, but it could collapse and go down 40 or 50% at some point. And so, yeah, I mean, those people are just confusing a bull market with brains. And if they don't want to listen to gold and silver analysis, then that's fine, and we'll invite other people who are the smart money who want to accumulate juniors and accumulate metals at good prices that have good long-term potential. Then we'll invite those people to follow our work.
And I don't think it's for my listeners out there, I don't think it's an either or scenario where you can only put your money into gold and silver mining shares or Bitcoin or these cryptos. I don't think that's the case, but I think people should be diversified. So you should own some gold and silver. You should maybe pick out some good mining shares or speculate a little bit in junior mining stocks. But what people, in addition to maybe owning some Bitcoin and some other cryptos, but that's not what people are doing from what I'm hearing. So what I'm hearing, Jordan, is that people are not having any diversification, that because the price signals of these altcoins and cryptos are going up, like Bitcoin has gone up, it's doubled since it went from 3,000 to below 2,000 in July. Real big correction. I thought it was a speculative buying opportunity when it had that big correction, and now it's doubled since the correction there to over 4,000. So I think it went over 4,500 today. So people are if you're prudent, maybe you should be taking some money off the top, sell a little bit of Bitcoin, rotate some of your profits into cheaper unloved assets. But that's not what a lot of people are, especially retail investors. That's not what a lot of retail investors are doing. They're actually putting more money into these cryptos the better the price action is.
Yeah, unfortunately for them, it's probably going to end in tears.
I'm not even sure, Jordan, if a lot of these trading platforms have ways to hedge yourself for risk management or stop losses and things, because some of these trading platforms are pretty rudimentary, and the trading volumes on some of these exchanges are not very good.
Yeah, I mean, like I said, I don't know a lot about Bitcoins, but I'm guessing it's probably an opaque market. And I mean, I know there's there might be an ETF or two out there, but people have to be really careful about getting involved in those things, especially at these prices. You really have to be an expert and know what you're doing.
Well, I think what people don't understand, Jordan, is there's actually more risk the higher something goes, because then you have to put more of your capital into it and you have a larger percentage of your portfolio. So there's actually, the higher the price goes on something, the more of your total portfolio it is, the more risk it is for you to be holding, that much of an asset. So the retail investor doesn't really understand this, but as a you as a CMT and me, 10 years working in the financial industry, this is something that now for some people, their cryptocurrency speculations are an enormous part of their portfolio. So you can't, if you do have enormous profits, it's probably smart, the higher these things go, to be taking more and more money off the table.
Yeah, that's actually a very good point, and that's one thing I talk about in my newsletter about how to sell, especially when you're in a bull market. Some people say if you're investing in really, really risky juniors, that if it doubles, you sell half. But you need to come up with your own selling strategy. But as something rises, it's good to sell in portions. And so those people who've made a lot of money on Bitcoin, they would be wise to start selling in small amounts. Maybe sell a little bit every month or every couple weeks. I mean, whatever you want to do, but that's how you reduce your risk when you have huge profits. And that way, if the market keeps climbing, you're still going to make money. But if it goes down, you're in effect decreasing your position, and you don't get hurt as badly. And by selling periodically when you have big profits, that removes your risk, that lowers your risk over time. And then also, as you said, you can rotate that money into other things that are cheap, like precious metals right now. And I'll just add, obviously I'm a gold bug, but there's a lot of, emerging markets had a clear bear market, and they bottomed in early 2016, like precious metals. And there's still some, even markets in Europe, the valuations in a lot of these markets that, you probably never hear them talked about ever. These things are looking better on the charts, and their valuations are very compelling. And so, that's where smart people are putting their money if they want to be in stocks. They're looking for those types of situations. They're not piling into the S&P after it's already tripled and gone up for 8 years. They're looking for, places where there's good value, they're trading well off their highs, but conditions are improving and there's good prospects for the future and lower risk up front.
Yeah, a lot of professional investors and value investors are not buying the S&P, like you said, although a lot of retail money, these passive index fund investors, are chasing the S&P higher. So, you know, they're like lemmings. So their herd mentality, they're probably going to get burned because they're buying into stock, you know, index funds now at these prices. So they're chasing it a lot higher, and they're not getting good value for their money. But I enjoyed our discussion today, Jordan. And if our listeners want to either read your book or sign up for their newsletter, how do they do so?
They can go to thedailygold.com and they can opt in. I have an opt-in box there on my site. I'm going to be giving out some good free material over the next month, so you can opt in for my free newsletter there. So that's a good sample of a lot of the work I do and some of the work that I do in the premium letter. I think there's a link for my book on my website. You can click on that and opt in there, and you'll get my book. And if you want to sign up for the premium service, it's thedailygold.com/premium. And if anybody wants to contact me, you can email me at jordan@thedailygold.com.
Excellent. Well, keep up the good work. And the link to your book is on your website. I see it on there. So if our listeners want to check that out, I'm sure it'll be good content. But thank you for your time, Jordan. And hopefully I can have you on again in the near future.
Thanks so much, Jason. It was a real pleasure.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.